This marks a turning point for monetary policy. After 8 interest rate hikes in a row, including some hefty increases, the central bank is cooling its jets for now. But it is keeping all options on the table, ready to increase the policy rate if needed to return inflation to the 2% target. The central bank admits that even though inflation is coming down, and this is mostly because of relief at the pumps, it is still too high. It was 5.9% in January, and the bank expects inflation to get down to about 3% by mid-year. Now, all those hikes over the past year have cooled the economy, and the housing market has reacted to this year's rapidly rising interest rate environment by pulling back. Still, this analyst expects homebuyer demand to return later this spring.
People really don't like uncertainty, and when there's uncertainty from a rate perspective, they tend to put off that buying decision.
Now, the pause is in stark contrast to what is expected from the U.S. central bank. Earlier this week, it signaled that interest rates in America are likely to be higher than previously anticipated. Diverging monetary policy will push the U.S. dollar higher and our loonie lower. Economists say that's likely to fuel food inflation.
The Canadian dollar will drop significantly against the US, and then we'll be paying more for the foods that we need, that we have to import, particularly at this time of the year, from places like US and Mexico, and a lot of those fruits and vegetables that we just can't grow here at this time of the year.
The Bank of Canada's decision to pause on interest rates makes it the first major central bank to do so. And even though inflation is at multi-decade highs here in Canada, the situation here is relatively better than what the US, UK, and other peer countries are dealing with. Anne Gaviola, Global News, Toronto.